Question 1. Which of the following statements best describes the key difference between a fixed annuity and a variable annuity? A. A fixed annuity guarantees a minimum interest rate, while a variable annuity's returns are dependent on the performance of underlying investments. B. A fixed annuity provides investment options, while a variable annuity does not. C. A fixed annuity is typically used for tax-deferred growth, while a variable annuity is used for tax-free growth. D. A fixed annuity offers variable payouts based on the performance of the stock market, while a variable annuity offers guaranteed payouts. Answer A. A fixed annuity guarantees a minimum interest rate, while a variable annuity's returns are dependent on the performance of underlying investments. Explanation: fixed annuities offer guaranteed returns and a predetermined payout, ensuring financial security regardless of market performance. The insurer takes on the investment risk. On the other hand, variable annuities allow the annuitant to invest in a range of securities such as mutual funds. The returns depend on the performance of these underlying investments, making variable annuities subject to market risk. This difference in investment risk is fundamental to distinguishing between the two products. Question 2. Mr. Smith, a 60-year-old retiree, is looking to invest in an annuity to ensure a steady income stream during retirement. He has a moderate risk tolerance but does not want to lose any of his principal investment. Which of the following annuity products would be most suitable for Mr. Smith? A. A fixed annuity with a guaranteed minimum income benefit (GMIB). B. A variable annuity with a death benefit rider. C. An indexed annuity with a cap on returns. D. A flexible premium deferred annuity. Answer A. A fixed annuity with a guaranteed minimum income benefit (GMIB). Explanation: a fixed annuity provides guaranteed payouts, making it a secure option for Mr. Smith, especially considering his desire to preserve principal and ensure a steady income stream. The guaranteed minimum income benefit (GMIB) rider guarantees a minimum level of income regardless of the performance of underlying investments, which aligns with Mr. Smith's risk tolerance. A variable annuity (option B) involves market risk, making it less suitable for Mr. Smith's preferences. Indexed annuities (option C) may also expose Mr. Smith to volatility, especially if he wants to avoid risk. A flexible premium deferred annuity (option D) is typically designed for those looking to accumulate funds over time rather than those seeking an immediate income stream. Question 3. A 62-year-old individual purchased an annuity with a 10-year surrender period. They decide to withdraw funds early due to an unexpected financial need. Which of the following statements is most accurate regarding the penalty they will face? A. The individual will not face any penalty since they are over 591 years old. B. The individual will face a penalty of 10% for early withdrawal plus any surrender charges stipulated in the contract. C. The individual will face a penalty equal to 20% of the amount withdrawn, regardless of the contract terms. D. The individual will face only the surrender charges with no additional penalty since they are over 591 years old. Answer B. The individual will face a penalty of 10% for early withdrawal plus any surrender charges stipulated in the contract. Explanation: under IRS rules, annuitants who withdraw funds from an annuity before the age of 591 generally face a 10% penalty on the early withdrawal in addition to ordinary income taxes. This penalty is designed to discourage early access to retirement savings. In addition to the IRS penalty, the individual will also be subject to surrender charges, which are typically imposed by the annuity issuer during the surrender period. The specific surrender charges depend on the terms outlined in the annuity contract. Therefore, both the IRS penalty and the surrender charges will apply in this scenario. Question 4. Which of the following best explains the accumulation period of an annuity? A. The period during which the annuitant receives regular income payments from the annuity. B. The period during which premiums are paid into the annuity and the value of the annuity grows, typically tax-deferred. C. The time after the annuity begins paying out that no further payments can be made into the contract. D. The time when the annuitant's beneficiaries begin to receive payouts upon the annuitant's death. Answer B. The period during which premiums are paid into the annuity and the value of the annuity grows, typically tax-deferred. Explanation: the accumulation period refers to the phase in an annuity contract where the annuitant makes premium payments and the contract value grows, usually on a tax-deferred basis. This period ends when the annuitant begins receiving regular payouts, i.e., the annuity period. During the accumulation phase, the annuity may earn interest or investment returns depending on the type of annuity: fixed, variable, indexed. Option A refers to the annuity period, not the accumulation period. Option C refers to the annuity payout phase. Option D refers to the death benefit phase, which is separate from the accumulation phase. Question 5. Which of the following is a characteristic of a joint and survivor annuity? It provides guaranteed income for the lifetime of the annuitant, but payments cease after the annuitant's death. B. It provides guaranteed income for both the annuitant and a designated beneficiary for their lifetimes. C. It pays out a lump sum to the beneficiary upon the death of the annuitant. D. It allows the annuitant to choose between monthly payments or a lump sum payout upon death. Answer: B. It provides guaranteed income for both the annuitant and a designated beneficiary for their lifetimes. Explanation: a joint and survivor annuity ensures that income payments will continue for the lifetimes of both the annuitant and a designated beneficiary, often a spouse. After the death of the first party, the survivor continues to receive income for their remaining lifetime. This option provides security for both individuals in a couple. Option A describes a single life annuity, while Option C refers to a death benefit feature that is not part of the payout structure. Option D describes an option that might be available in some annuities, but is not specific to a joint and survivor annuity. Question 6. Mrs. Williams is 70 years old and considering a variable annuity with a guaranteed minimum death benefit rider. Which of the following statements most accurately describes the benefit of this rider? A. The GMDB guarantees a minimum return of the premiums paid to the annuity even if the market value of the annuity declines. B. The GMDB guarantees that the annuity will pay out a lump sum to the beneficiary based on the current value of the contract at death. C. The GMDB provides a guarantee that the annuitant will receive fixed income payments regardless of market performance. D. The GMDB guarantees that the beneficiary will receive no less than the initial premium amount even if the market value of the annuity is less than the premiums paid. Answer: D. The GMDB guarantees that the beneficiary will receive no less than the initial premium amount, even if the market value of the annuity is less than the premiums paid. Explanation: the guaranteed minimum death benefit rider ensures that the beneficiary receives at least the amount of the premiums paid into the annuity, regardless of how poorly the underlying investments perform. This provides a level of protection for the annuitant's heirs. Option A is incorrect because the GMDB is not concerned with the return of premiums, but rather the minimum death benefit. Option B is incorrect because the death benefit is not based on the current market value of the contract, but on the premium amount or other defined minimum. Option C incorrectly describes a guaranteed income benefit, not a death benefit. Question 7. Which of the following is an example of a suitability issue in the sale of an annuity? A. Selling a deferred annuity to a 25-year-old investor planning to retire at age 30. B. Recommending an annuity with a high fee structure to a client who is seeking tax-deferred growth. C. Disclosing all fees and surrender charges associated with the annuity purchase. D. Offering a variable annuity with equity investments to a conservative investor who prefers low-risk options. Answer: D. Offering a variable annuity with equity investments to a conservative investor who prefers low-risk options. Explanation: suitability in annuity sales requires the agent to recommend an annuity product that aligns with the client's financial goals, risk tolerance, and overall needs. In this case, a variable annuity with equity investments, which involves market risk and volatility, would not be suitable for a conservative investor with low-risk preferences. Option A could also present a suitability issue if the annuity is intended for long-term growth but purchased by someone with a short-term investment horizon. Option B is not a suitability issue because the high fee structure is more of a transparency and disclosure issue rather than one of suitability. Option C is correct in terms of disclosure requirements but does not describe a suitability issue. Question 8. In the context of Kansas law, which of the following must be disclosed to a consumer before purchasing an annuity? A. The insurance company's ratings from various credit agencies. B. The total amount of commissions paid to the agent and the insurer. C. Any surrender charges, penalties, and fees that may apply to the annuity. D. The annuity's guaranteed interest rate and the date on which it will be paid out. Answer: C. Any surrender charges, penalties, and fees that may apply to the annuity. Explanation: Kansas law requires that agents provide full disclosure of any fees, surrender charges, or penalties that could apply to an annuity. This ensures that consumers are fully informed of the costs associated with the product before purchase. Option A, while useful for evaluating the insurer's financial stability, is not required by Kansas law for annuity sales. Option B is not typically required for disclosure, as agent commissions are not usually disclosed directly to the consumer. Option D, while relevant for understanding the annuity, does not specifically address the required disclosures in Kansas law. Question 9. Mr. Peterson is 58 years old and considering a withdrawal from his annuity to cover unexpected medical expenses. What penalty will he incur on the withdrawal? A. No penalty, as he is over 591 years old. B. A 10% early withdrawal penalty because he is under the age of 591. C. A 20% penalty for early withdrawals. D. A penalty based on the contract surrender charges, but no additional penalties under tax laws. Answer. B. A 10% early withdrawal penalty because he is under the age of 590. Explanation. Under IRS rules, any annuity withdrawals made before the age of 591 is subject to a 10% early withdrawal penalty. This penalty is applied to the amount of the withdrawal in addition to regular income tax that may be owed. Option A is incorrect, as Mr. Peterson is under 591, so no penalty-free withdrawal applies. Option C is incorrect because the IRS penalty is 10%, not 20%. Option D is partially correct because surrender charges may apply, but the tax penalty also applies to early withdrawals under 591, making option B the most accurate. Question 10. Which of the following is a feature of indexed annuities? A. They offer unlimited returns based on market performance. B. They provide a guaranteed return based on the performance of a stock market index, with caps and floors limiting the return. C. They invest in mutual funds and are directly linked to the stock market's performance. D. They guarantee a fixed interest rate for the life of the annuity contract. Answer. B. They provide a guaranteed return based on the performance of a stock market index, with caps and floors limiting the return. Explanation. Indexed annuities are linked to a market index like the S&P 500, and they offer a return based on the performance of that index. However, the return is subject to caps, maximum returns, and floors, minimum returns, which protect the annuitant from significant losses, but also limit potential gains. Option is incorrect because indexed annuities do not provide unlimited returns, they are capped. Option C is incorrect because indexed annuities are not directly invested in mutual funds. Option D describes a fixed annuity, not an indexed annuity. Question 11. Which of the following statements best describes a single premium immediate annuity? A. It is an annuity purchased with a lump sum that begins to pay out income immediately after the premium is paid. B. It is an annuity that requires multiple premium payments over a set period before payments begin. C. It is an annuity that provides a fixed monthly income for a set period with a lump sum refund at the end. D. It is an annuity that accumulates value before income payments begin. Answer. A. It is an annuity purchased with a lump sum that begins to pay out income immediately after the premium is paid. Explanation. A single premium immediate annuity (SPIA) is purchased with a one-time lump sum premium and begins making periodic income payments immediately, typically within one payment period after the purchase. It's designed to provide immediate income, and unlike other annuities, it does not have an accumulation phase. Option B describes a flexible premium annuity. Option C refers to a different type of annuity with refund options. Option D describes an annuity with an accumulation phase, not an immediate annuity. Question 12. Which of the following annuity types provides payments that vary depending on the performance of the underlying investments? A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Immediate annuity. Answer. B. Variable annuity. Explanation. A variable annuity allows the annuitant to choose from a range of investment options, and the payments fluctuate based on the performance of these investments. This type of annuity has the potential for higher returns, but also higher risks, as payments can decrease if the investments underperform. Fixed annuities provide guaranteed payments, while indexed annuities link payments to a market index. Immediate annuities provide fixed payments starting immediately. Question 13. Which of the following is true regarding the tax treatment of annuities? A. Annuities are tax deferred, meaning the earnings grow without being taxed until withdrawals are made. B. Annuities are taxed immediately on the earnings portion as soon as they are purchased. C. Annuities are tax-free after the age of 591. D. Annuities are not subject to taxation under any circumstances. Answer. A. Annuities are tax deferred, meaning the earnings grow without being taxed until withdrawals are made. Explanation. Annuities are tax-deferred, meaning that the earnings grow without being taxed until the annuitant makes withdrawals. At that time, the portion of the withdrawal that represents earnings is subject to income tax. Option B is incorrect because the earnings are not taxed immediately. Option C is incorrect because the tax deferral lasts until the withdrawals are made, regardless of age. Option D is incorrect because annuities are taxed on earnings. Question 14. Which of the following is an advantage of a fixed indexed annuity over a variable annuity? A. It provides the potential for unlimited growth based on stock market performance. B. It guarantees a minimum return, regardless of market conditions. C. It provides fixed monthly payments for life without any fluctuation. D. It allows unlimited withdrawals without penalties. Answer. B. It guarantees a minimum return, regardless of market conditions. Explanation. A fixed indexed annuity guarantees a minimum return, typically 0%, meaning that even in a down market, the annuitant will not lose money. This provides some protection against market volatility, unlike a variable annuity where the returns are subject to the performance of the underlying investments. Option is incorrect because the growth in a fixed indexed annuity is not unlimited and is capped. Option C describes a fixed annuity, not an indexed annuity. Option D is incorrect because withdrawals from annuities often come with penalties or surrender charges, especially during the early years. Question 15. What is the primary function of a rider in an annuity contract? A. To allow the annuitant to withdraw a portion of the premium tax-free. B. To modify the basic terms of the annuity by adding specific benefits or features. C. To increase the premium paid into the annuity contract. D. To guarantee a fixed income stream to the annuitant for life. Answer. B. To modify the basic terms of the annuity by adding specific benefits or features. Explanation. A rider is an additional feature that can be added to an annuity contract to modify its terms and provide extra benefits such as long-term care protection, death benefits, or enhanced payouts under certain conditions. Riders can tailor the annuity to fit the specific needs of the annuitant. Option A refers to a tax-free withdrawal, which is not typically a feature of annuity riders. Option C is incorrect as riders generally do not involve changing premium payments. Option D refers to guaranteed income, which is a characteristic of certain annuities, but not specifically related to riders. Question 16. Which of the following scenarios would require an annuity agent to perform a suitability analysis for the client? A. When recommending an annuity to someone under the age of 18. B. When the client requests an annuity product with a guaranteed income feature. C. When the client's age, income, and financial goals are aligned with the annuity being recommended. D. When the annuity is being sold solely for its tax-deferred growth. Answer. C. When the client's age, income, and financial goals are aligned with the annuity being recommended. Explanation. Suitability is a regulatory requirement where the agent must ensure that the recommended annuity is appropriate for the client based on their financial goals, age, income, and other relevant factors. An annuity that matches these characteristics will be suitable for the client's needs. Option A is not applicable to suitability. Minors cannot legally enter into annuity contracts. Option B does not necessarily trigger suitability analysis on its own. It's the combination of factors that matter. Option D focuses on tax-deferred growth, but suitability involves ensuring the entire product aligns with the client's needs. Question 17. Which of the following best describes a systematic withdrawal plan of an annuity? A. A plan where the annuitant receives a fixed income for the rest of their life. B. A strategy where the annuitant withdraws a set amount of money regularly from the annuity's accumulated value. C. A feature that provides additional funds if the annuitant's account falls below a certain level. D. A method of investing the annuity's funds in the stock market to maximize returns. Answer. B. A strategy where the annuitant withdraws a set amount of money regularly from the annuity's accumulated value. Explanation. A systematic withdrawal plan allows an annuitant to withdraw a predetermined amount of money on a regular basis, e.g., monthly or annually, from the accumulated value of the annuity. The amount withdrawn typically decreases the value of the annuity. Option A describes an annuity payout option, not an SWP. Option C is incorrect because SWP does not provide additional funds in the case of low account value. Option D describes an investment strategy, not a withdrawal plan. Question 18. What is the typical effect of early withdrawal from an annuity before the age of 591, where the withdrawal is completely tax-free? B. The withdrawal is subject to a 10% penalty and ordinary income tax on the earnings. C. The withdrawal is not subject to any penalties if the annuity is under 10 years old. D. The withdrawal is subject to capital gains tax rather than ordinary income tax. Answer: B. The withdrawal is subject to a 10% penalty and ordinary income tax on the earnings. Explanation: if an annuitant withdraws funds from an annuity before the age of 591, where the IRS imposes a 10% penalty on the earnings portion of the withdrawal in addition to the ordinary income tax that is owed on the earnings. Option A is incorrect because withdrawals before age 591 were not tax-free. Option C is incorrect because early withdrawals are penalized regardless of the annuity's age. Option D is incorrect because annuity withdrawals are taxed as ordinary income, not capital gains. Question 19. Which of the following is true about the death benefit rider in a variable annuity? A. It guarantees that the annuitant's beneficiary will receive at least the original principal invested. B. It ensures that the beneficiary will receive the entire market value of the annuity at the time of death. C. It provides a fixed payout for a predetermined period after the annuitant's death. D. It allows the beneficiary to continue receiving income for life after the annuitant's death. Answer A. It guarantees that the annuitant's beneficiary will receive at least the original principal invested. Explanation: the death benefit rider in a variable annuity guarantees that the beneficiary will receive at least the amount of the original premium or the minimum benefit amount if the annuitant passes away before the annuity payments begin. This is particularly important in a variable annuity where the value can fluctuate with market performance. Option B is incorrect because the death benefit does not necessarily equal the entire market value. It may be capped at the initial investment amount. Option C describes a different type of benefit not typically associated with the death benefit rider, which provides a guaranteed payout for a certain period. Option D refers to a different type of rider or benefit, such as a lifetime income rider, not a death benefit. Question 20. Which of the following best describes the guarantee minimum withdrawal benefit rider in a variable annuity? A. It guarantees the annuitant a fixed interest rate during the accumulation phase. B. It ensures that the annuitant will receive a certain percentage of their initial investment as regular income regardless of market performance. C. It allows the annuitant to withdraw their entire premium amount at any time without penalty. D. It guarantees that the annuitant's beneficiary will receive the full market value of the annuity at the time of death. Answer: B. It ensures that the annuitant will receive a certain percentage of their initial investment as regular income regardless of market performance. Explanation: a guaranteed minimum withdrawal benefit in a variable annuity ensures that the annuitant can withdraw a certain percentage of their initial investment over time, regardless of the performance of the underlying investments. This rider provides a level of security during the annuitant's retirement by guaranteeing income even if the market performs poorly. Option is incorrect because the GMWB does not focus on fixed interest rates but on withdrawal guarantees. Option C is incorrect because withdrawals are typically subject to rules and the full premium may not be withdrawn without penalties. Option D refers to death benefits, not the GMWB. Question 21. In the context of annuities, what does the term tax-deferred mean? A. The annuity earnings are taxed when they are paid out to the annuitant. B. The annuity's premiums are tax-deductible when paid. C. The annuity's earnings are taxed annually even during the accumulation phase. D. The annuity's earnings are not taxed until they are withdrawn or annuitized. Answer: D. The annuity's earnings are not taxed until they are withdrawn or annuitized. Explanation: tax-deferred means that the annuity's earnings grow without being subject to tax during the accumulation phase. Taxes are only due when the funds are withdrawn or when the annuitization phase begins, which typically results in the earnings being taxed as ordinary income. Option is incorrect because taxes are deferred during the accumulation phase. Option B is incorrect because annuity premiums are generally not tax-deductible unless they are part of a qualified retirement plan. Option C is incorrect because earnings are not taxed annually in a tax-deferred annuity. Question 22. Which of the following factors can affect the amount of income an annuitant receives from a variable annuity? A. The performance of the underlying investments in the annuity. B. The insurance company's guaranteed minimum interest rate. C. The annuitant's age at the time of annuitization. D. All of the above. Answer: D. All of the above. Explanation: the amount of income an annuitant receives from a variable annuity is affected by multiple factors. The performance of the underlying investments in the annuity will influence the income, as variable annuities payouts are tied to the performance of the chosen investment options. The insurance company's guaranteed minimum interest rate can also provide a baseline for income if the market performs poorly. Additionally, the annuitant's age at the time of annuitization can impact the income because older annuitants are expected to live a shorter time, leading to higher income payouts. Thus, all these factors contribute to the income amount. Question 23. What is the primary advantage of purchasing a deferred annuity? A. It provides immediate income for the annuitant. B. It allows the annuity's value to grow tax-deferred until withdrawals begin. C. It guarantees the annuitant will never outlive their income. D. It provides higher interest rates than other types of annuities. Answer: B. It allows the annuity's value to grow tax-deferred until withdrawals begin. Explanation: a deferred annuity allows the annuity's value to accumulate on a tax-deferred basis during the accumulation phase. This means that earnings are not subject to taxes until withdrawals or the annuitization phase begins. Option is incorrect because a deferred annuity does not provide immediate income. It is designed for future income. Option C describes a characteristic of lifetime income options, not the primary advantage of a deferred annuity. Option D is incorrect because interest rates are dependent on the type of annuity and the market conditions, not a guaranteed feature of deferred annuities. Question 24. What is a premium bonus in the context of an annuity contract? A. A bonus given to the annuitant when they select a payout option. B. An additional amount added to the annuity's value by the insurance company, often as an incentive for purchasing the annuity. C. A return on investment added to the annuity's value by the insurer. D. A lump sum payment made at the end of the annuity's accumulation phase. Answer: B. An additional amount added to the annuity's value by the insurance company, often as an incentive for purchasing the annuity. Explanation: a premium bonus is an additional amount that the insurance company may add to the annuity's value to incentivize the annuity purchase. This bonus is typically a percentage of the premium paid and can be seen in some fixed annuities and variable annuities. Option is incorrect because the bonus is not related to payout options. Option C is incorrect because a return on investment is not the same as a premium bonus. Option D is incorrect because a premium bonus is applied during the accumulation phase, not at the end. Question 25. Which of the following is a feature of a life-only annuity? A. The annuitant receives income payments for a specified period regardless of whether they are alive. B. The annuitant receives income for the rest of their life, but no payments are made after their death. C. The annuitant receives income that can be passed on to a beneficiary after their death. D. The annuitant receives a lump sum payment at the time of annuitization. Answer: B. The annuitant receives income for the rest of their life, but no payments are made after their death. Explanation: a life-only annuity provides the annuitant with income for as long as they live. Once the annuitant passes away, no further payments are made, and the beneficiary does not receive any income. This option typically results in higher monthly payments than other types of annuities with death benefits because the insurer is not obligated to continue payments after the annuitant's death. Option is incorrect because life-only annuities provide income for the annuitant's lifetime, not a fixed term. Option C refers to a joint and survivor or other death benefit options, not a life-only annuity. Option D is incorrect because life-only annuities provide ongoing income, not a lump sum. Question 26. Which of the following is a characteristic of a fixed annuity? A. The annuity's value fluctuates with the stock market. B. It guarantees a fixed interest rate for the entire accumulation phase. C. The income payments are based on the performance of underlying investments. D. It provides no tax advantages for the annuitant. Answer: B. It guarantees a fixed interest rate for the entire accumulation phase. Explanation: a fixed annuity provides a guaranteed fixed interest rate during the accumulation phase, which ensures that the annuity's value grows at a predictable rate. This makes it a safer option compared to variable annuities, where the value can fluctuate based on market performance. Option is incorrect because a fixed annuity's value does not fluctuate with the stock market. Option C is incorrect because income payments in a fixed annuity are not based on investments but on the terms of the contract. Option D is incorrect because fixed annuities typically offer tax-deferred growth on earnings. Question 27. Which of the following best describes a joint and survivor annuity option? A. The annuitant receives a fixed income for a specified period, with payments continuing to the beneficiary for the same period after their death. B. The annuitant receives a higher monthly income, but payments stop when the annuitant dies. C. Both the annuitant and their spouse receive payments for life, with the spouse continuing to receive payments after the annuitant's death. D. The annuitant receives a lump sum after a predetermined number of years. Answer C. Both the annuitant and their spouse receive payments for life, with the spouse continuing to receive payments after the annuitant's death. Explanation: a joint and survivor annuity provides income to both the annuitant and their spouse for life. After the annuitant's death, the surviving spouse continues to receive payments either for life or a reduced amount. Option A refers to a term certain annuity, not a joint and survivor option. Option B describes a life-only annuity where payments stop after the annuitant's death. Option D describes a payout schedule that is not tied to life insurance, so it's not relevant to joint and survivor annuities. Question 28. What is a 7-pay test in the context of life insurance and annuities? A. A test to determine whether the annuity's premiums exceed the allowable contribution limits within the first 7 years. B. A test used to calculate the minimum payout required for an annuity. C. A requirement that the insurance company must pay 7 annual installments before the annuitant can access their funds. D. A rule to ensure that an annuity meets the tax qualifications for tax-deferred status. Answer D. A rule to ensure that an annuity meets the tax qualifications for tax-deferred status. Explanation: the 7-pay test is used to determine whether a life insurance policy or annuity is a modified endowment contract, MEC and MEC, is subject to less favorable tax treatment than a traditional life insurance policy. This test ensures that the policy does not accumulate too much value in a short period, i.e., within the first 7 years. If premiums exceed the limits established by the test, the policy is considered an MEC and may be subject to taxation on withdrawals. Option is incorrect because the 7-pay test concerns premium contributions, not payout limits. Option B and C do not accurately describe the 7-pay test. Question 29. Which of the following is a disadvantage of a variable annuity? A. It offers a fixed interest rate for the accumulation phase. B. It provides income that is guaranteed for life, regardless of market conditions. C. It has the potential for higher returns, but also carries the risk of loss in value. D. It is not subject to state regulation. Answer C. It has the potential for higher returns, but also carries the risk of loss in value. Explanation: a variable annuity offers the potential for higher returns because the funds are typically invested in a range of market-based options, such as stocks or bonds. However, this also means the value can decrease based on market performance, making it riskier than fixed annuities. Option is incorrect because variable annuities do not guarantee a fixed interest rate during the accumulation phase. Option B is incorrect because the income in a variable annuity is not guaranteed. It depends on the performance of the investments. Option D is incorrect because variable annuities are regulated by state insurance departments. Question 30. What does the spendthrift clause in an annuity contract do? A. It prevents the annuitant from withdrawing funds before a set period. B. It protects the annuity from creditors in case the annuitant faces financial difficulties. C. It guarantees that the annuitant's beneficiary will receive the annuity's value upon the annuitant's death. D. It ensures that annuity income payments can be shared with multiple beneficiaries. Answer: B. It protects the annuity from creditors in case the annuitant faces financial difficulties. Explanation: the spendthrift clause is a provision in an annuity contract that protects the annuity's value from being seized by creditors even if the annuitant faces financial hardship. This clause ensures that the annuity payments cannot be garnished or accessed by creditors. Option is incorrect because the spendthrift clause is not related to withdrawal restrictions. Option C refers to death benefits, not the spendthrift clause. Option D is incorrect because a spendthrift clause does not relate to sharing income payments.